I think the markets can go higher from here. And I'd say two things. First, we have to acknowledge earnings. That earnings are, really the catalyst here to allow markets to move higher. I think in the third and fourth quarter, we'll see S&P earnings growth north of 20% in each of the two quarters. But the bigger, longer-term bullish trend, in my opinion, is investor positioning. And this is something that gets a little bit less attention because here we are, in the longest bull market in post-World War history, World War II history, and this is still an under-owned, under-allocated equity market. In fact, if you look at investor flows year to date, when you combine both mutual fund and ETF flows, we're on pace to see the biggest outflows since 2012. So in other words, investors remain very skeptical, and that is actually a bullish sign because when you look at every other bull market going back to 1980, what you normally find is flows start to pick up and they really hit a peak around the time the market peaks. It's extremely unusual for a market to peak when you're in outflow mode. So I think that gives us more long-term confidence that this bull market is far from over.
Why do you think we're in outflow mode? Is that investors who have been burned so badly?
I think that's a part of it. There's an economic term called recency bias, where you take what happened in the recent past and you apply it to the future. And so I think people are still living in the shadows of the great financial crisis, 2007,
coming up
2008.
on the 10-year anniversary.
Yeah, and they don't let it go. Yet when you look at what's been happening in the market, we've got terrific fundamentals, an accelerating economy, strong earnings growth, continued low rates. You've got everything set for a sustained, long-term bull market that I think will break all records before it's done. And the key thing here is that investors remain very skeptical. That's a contrarian bullish.
So I would say I agree with you that investors are not chasing it, right? But the market has done their allocation for them. If you just look at where their money is, I look at things like Merrill Lynch's private client cash levels are very low, equity exposure is at a high for this cycle. So the markets kept going up, and we all have smart advisors now who kind of reallocate whether they're robots or not. So I just wonder if that's going to be the thing that triggers that signal that says, aha, everyone loves this market too much.
Yeah, and I think that's a great point, right? And when you look at flows, they've basically gone everywhere else except for U.S. equities. They've gone international, they've gone emerging markets. They've hit records going into fixed income. And the point is, when people are allocating to those other buckets or those other segments of the market, they're still making a sell decision, right? Because they've got to sell something in order to fund international or fund emerging markets or fund, traditional fixed income. And what they're continuing to do is draw down equities. Now, equity levels are rising, which is pushing their allocations up higher naturally, but they're still reluctant to embrace it, to say, this is the best opportunity in the world. And as long as they're, avoiding that, or as long as they're allocating away from that, I think it's actually this contrarian sign that says we're not overowned, we're not overbought, and we'll go higher.
Jason, I know you've been very bullish for quite a while.
Yeah.
We had an economist earlier who said, look, things are going to slow down in 2019, and you're going to have the Fed raising rates. Does that worry you?
Well, listen, I'm not sure I quite agree with that. I'm of the view that the most non-consensus view, and I agree with virtually everything Joe just said, which should probably maybe worry people that we have such a consensus here. But by the
That's a rare consensus around the table.
By the same token, though, I think the most non-consensus idea is the idea that you could have a longer business cycle. And again, I'm a supply side person, so I look at the tax cuts and I would say the single most, the biggest contributor of a long cycle could be capital spending that leads to productivity, because productivity has been one of the things in this 9-year expansion that's been conspicuously absent. So if you have a productivity boom that's driven by capital spending, profits go up, wages go up, unit labor costs stay low, so the Fed doesn't have to get overly aggressive, and you could have a very long cycle. So I'm not a big believer in the peak. I think we're in peak growth of earnings simply because you had a tax cut, but you're not at peak earnings as far as absolute levels.